Hey there and welcome to our channel. In today's video, we'll be discussing the consequences of low interest rates, a look at the financial system's fragility. We're excited to share our thoughts and insights with you, so let's get started. Today's video on the world's addiction to low interest rates. This is the story of what happens when the era of cheap money comes to an end. Investors have been spoiled for 2 decades by super low interest rates, but that time is over. Inflation is here for the first time in most investors' living memories, and this changes everything. We're seeing some cracks in the financial system as 30 years of falling bond yields may be coming to an end. Suddenly, we're at an inflection point. What a decade of easy monetary policy did was encourage people to take greater risks. When you see rates rise as quickly as they have, often there are things that break. This is a complicated constellation of risks. It's only when the tide goes out that you see who's been swimming naked. So let's rewind to 2008, the global financial crisis. This was due to leverage and too much borrowing, particularly in the US mortgage market. Central banks had to inject huge liquidity into the financial system. In the immediate aftermath of the crisis, central banks had to slash interest rates and buy up vast quantities of government debt under quantitative easing programs. This was a new thing, really. We saw central banks buying back huge amounts of government bond markets. Trillions of dollars worth of government IOUs ended up being owned by central banks instead of traditional investors. This set forth a paradigm of inexpensive money and a feeling that there was a Fed put below the markets. Ever since that point, we've had loose monetary policy with interest rates heading all the way down to zero. Most of the government bond markets of the world had negative yielding government bonds. This existed until the pandemic hit and central banks and governments stepped in aggressively to support the economy. The world has changed. Inflation is here for the first time in most investors' living memories, and this changes everything. In the last segment, we discussed the impact of inflation on the financial system. In this segment, we will delve deeper into the specific impact on the liability-driven investing or LDI market. The supply of something goes up. Investors respond by selling it. You see UK borrowing costs leap higher on the day of the budget. This resulted in the biggest amount of gilt issuance that we've ever seen. The more bonds that are issued, the more that the market has to buy, the lower price the government will have to sell those at. The pound crashes to its all-time low against the dollar. Usually, higher interest rates would be good for your currency. But we have this sense that the international investment community has lost confidence in UK economic policymaking. And that caused a whole bunch of forced selling in the LDI market. LDI has been at the center of this. This is a strategy used by certain pension schemes to protect them against big swings in interest rates. The reason that they need to do that is because moves in long-term interest rates mean that their liabilities, the money that they have to pay out to pensioners for decades in the future, swings up and down wildly. Now, one way that they can protect themselves against that is by owning lots of gilts, long-term government bonds, that will also see wild swings in their prices as long-term interest rates move. That works if you are able to fill your pension portfolio with 100% gilts. In practice, it doesn't work that way. There are shortfalls in the funding of these schemes, so they need to buy riskier assets as well. The returns that you can get out of bonds have been falling for years. So they think, well, we need to enhance returns. They need to hedge themselves against the risk that bond yields could fall further. And that's where derivatives come in that effectively synthetically create the same effect of holding long-term gilts, that using leverage, using borrowed money. The problem is that if bond yields rise, pension funds have to pay out that money. That can mean that they have to sell assets really quickly. As gilt yields climbed rapidly in the wake of the budget, that meant that those swapped positions moved against the pension funds. The type of moves that are supposed to be only seen once in a generation in the gilt market, we had that happening 3 days in a row. The Bank of England had to step in. Something had to give. Ordinary people who pay mortgages could see that the rates on those mortgages were shooting through the roof. Mortgage lenders were pulling out of the market. It could have developed into a financial crisis. The LDI dynamic exposed the stresses that can happen in the system when you have a very sharp rise in interest rates. Loose fiscal policy combined with an inflationary backdrop, very dangerous. And I think, in conclusion, the world's addiction to low interest rates has led to a complicated and dangerous situation in the financial system. The impact of inflation and the specific impact on the LDI market have highlighted the need for careful and responsible economic policymaking. In the previous segments, we discussed the impact of inflation on the financial system, and the specific impact on the liability-driven investing or LDI market. In this segment, we will explore the potential risks to the global economy, focusing on the Treasury market and the Japanese government bond market. The Treasury market is the world's most important bond market. So dysfunction in that market is not going to be tolerated by the Federal Reserve. However, there have been cracks in the market, such as in March 2020, when there was a broad dash for cash as investors panicked in the face of the pandemic. The nightmare scenario is that we see similar volatility in the U.S. Treasuries market as we have seen in gilts. This could be a disaster for the global economy. Bank of America has researched potential fragilities in the U.S. Treasuries market. If the market fails to trade for a period of time, various credit channels, including corporate, household, and government borrowing, would cease. This could lead to events such as U.S. government debt default, inability to convert treasuries to cash, inability to produce benchmarks for the derivatives market, and inability to issue or trade debt for corporates, municipalities, insurance companies, and banks. This could potentially be one of the biggest risks to financial stability since the housing bubble of 2006-2007. We are facing a recession across developed markets, a slowdown in China, geopolitical risk, and a war in Europe. Investors may seek a flight to safety, which should support the U.S. Treasury market. However, yields can rise quickly as prices fall in bond markets. This could cause problems for hedging contracts and modeling that is predicated on rates moving slowly. Thanks for watching our video. We hope you enjoyed it and learned something new. If you liked it, please give it a thumbs up and consider subscribing to our channel for more content like this. Don't forget to leave a comment and let us know what you thought. Until next time, take care.